For this session, we are to talk now with your different intercompany transactions. So in an intercompany transaction, this happens whenever the acquirer and the acquiree have business transactions with each other. Okay, so the acquirer and the acquiree has business transaction with each other. So what are those business transactions? Generally, in consolidations, we talk about these transactions. The first transaction is the intercompany sale of inventory. What is this intercompany sale of inventory? For example, acquirer will sell inventory to acquiree, or acquiree will sell inventory to your acquirer. Next, we have your intercompany sale of property, plant, and equipment. Intercompany sale of property, plant, and equipment. On the first one, what is sold in between the acquirer and acquiree is an inventory. In your intercompany sale of PPE, what is sold in between them is property, plant, and equipment. Third one, we have your intercompany accounts. So what are these intercompany accounts? These are the AR and AP of each other. So the acquirer has either receivable from your acquiree, and your acquiree has a payable to your acquirer, or the acquirer has a payable to your acquiree, therefore your acquiree has a receivable. Now, in your intercompany, what is important here is to take note that since the acquirer and the acquiree undergone business combination, once there is a business combination, they are already considered as one entity. One entity. Therefore, since they are considered one entity, if there is an intercompany sale of inventory, we should remove that. Sir, why? Because you cannot sell inventory on yourself. They are already considered one entity, therefore the acquirer cannot sell to acquiree an inventory, or the acquiree will sell inventory to the acquirer. That cannot be. Because they are considered one entity, therefore you cannot sell to yourself. So even if you sell to your acquiree, you consider your acquiree as your own. Therefore, you cannot sell on your own. Okay? So in your business combination, take note, since they are already combined, they are considered one entity. Hence, any sale in between them is not applicable. They are considered one entity. Why? Under the rules of accounting, you should only record if ever there is a outside transaction. If that is an inside transaction, just like this, your intercompany sale of inventory, intercompany sale of property, plant, and equipment, and intercompany accounts, you should not record that because you cannot sell on yourself. You cannot make a gain on yourself. Because parang nakakatuwa naman na, oy, bentahan ko nga yung sarili ko para meron akong gain on my sale. Uy, bentahan ko nga yung sarili ko para tumaas yung profit ko. That cannot be. Because under accounting, again, what do we say? The acquirer and acquiree are considered one entity. They being considered as one entity, we must remove any intercompany transactions. And what are those intercompany transactions that we should remove? First, we remove your intercompany sale of inventory. Next, we remove your intercompany sale of property, plant, and equipment. Lastly, we remove your intercompany accounts, such as your accounts receivable and accounts payable. Okay, so we start now with our first intercompany transaction. So what is our first intercompany transaction? Our first intercompany transaction is known as your intercompany transaction of inventory. Intercompany sales of merchandise. Okay, so what happens in your intercompany sales of merchandise again? So we have your acquirer and your acquiree. They will sell to each other inventory. The problem here is that normally your inventory will stay to your acquirer or your acquiree. Remember, we will only record a transaction once we sell it to your outside party. So in short, if that inventory is sold to third party, then we can recognize your inventory sale. Okay? So for example, the acquirer will sell to the acquiree inventory. Now, if ever the acquiree will sell that to a third party, that is considered a valid sale. The question now is, what happens to inventory unsold? So let's say acquirer, acquiree. So acquirer, okay? Binenta niya kay acquiree for 500 pesos. Okay? Ang cost ay 100 pesos. So si acquiree, nabenta niya lang yung kalahati niyan. So 250. Okay? Nabenta lang ni acquiree yung kalahati niyan. So galing dyan yan, 1/2, 250 for let's say 700. Okay? So binentahan ni acquirer si acquiree ng 100 cost na inventory for 500. In return, nabenta daw ni acquiree yung 250 for 700. Clear? Okay. Now, our problem here is that ang nabenta lang naman talaga, ay 1/2. So if we consolidate that, what will happen is 1,200 to tas 350 to. Wrong yan. Kasi ang cost lang naman talaga is 1/2 niyan, which is 50. And ang nabenta talaga is 700. Okay? Ang nabenta talaga is yung third party na 700 and 1/2 nitong 100, which is 50. Now, our problem now is how do we remove those items? Okay, so under our standard, it is provided that the unrealized profit in ending inventory through intercompany sales above cost are not resolved to your third parties. This must be removed. So unrealized profit daw on our ending inventory should be removed. So what is our unrealized profit? Okay. Our unrealized profit here, so our total profit, di ba kasi ang nagbenta si acquirer, binenta niya kay acquiree. Ang cost lang daw ng pagbenta niya ay 100. Ang selling price ay 500. So magkano ang total profit niya para doon? 400. 400. 1/2 daw nabenta niya. 1/2 nabenta. And then, 1/2 hindi nabenta. Okay. So yung hindi nabenta, ang tawag dyan ay unrealized profit. Okay? So yung hindi nabenta ay unrealized profit. So out of 400, magkano ang hindi nabenta? 1/2 daw. So that is 200. That is 200. Okay? So any unrealized profit should be removed. Okay. So once we remove your unrealized profit, then it would be easier for us to consolidate. Next, the profit on the selling is overstated because the arm's length transaction has not yet taken place. What is our arm's length transaction again? Our arm's length transaction is once we sell it to your third party. Since there is no sale yet, our unrealized profit or profit is overstated. Further, the inventory is also overstated by the amount of our unrealized profit. So ang main problem talaga natin dito ay unrealized profit. This unrealized profit is also the amount of our overstatement in inventory. Clear? Okay. Let's go back to our example. Let's erase all these items so that we could understand it again. Okay. So in our example, we said that the acquirer sold to the acquiree an inventory worth 100 for 500 pesos. The acquiree only sold 1/2 of it. So the 1/2 of the cost of acquiree is 250 and the selling price is 700. So without consolidation, ang lalabas ay ganito. I-add mo lang yung dalawa. Okay? But actually, the arm's length is nabenta daw ni acquiree for 700 at 1/2 lang daw yung nabenta dito. Okay, kaya ang arm's length lang ay 700 at saka 50. So how do we make our intercompany sales of merchandise elimination? So we will make an elimination. So we have here acquirer And then we have here your acquiring. So the total sales, total cost of goods sold, and total gross profit. So 500, 100, 700, at saka 250. How much is the gross profit of acquirer? 400. How much is the gross profit of acquiree? 700 less 250. This will give us 450. What is our problem? First, we need to get for your unrealized profit. So how much is the profit of acquirer? 400. How much daw is unrealized profit? That is the percent that is unsold. Ilan daw ang unsold at the end? 1/2. So 400 less 1/2, that is 200. Okay. So for your elimination, what you do is elimination. What you do, guys, is first, you remove the unrealized gross profit in the gross profit. So yan, 200. Next, you remove the sale of the seller. You remove the sale of the intercompany seller. Who sold here? The acquirer sold to acquiree. So you remove that. 500 yan. Any remainder is a reduction to your cost of sales. So 500, 200. Magkano yung remainder para magkaroon ka ng 200 dito? 300. Gets? So 500 to. Tama. So 500, magkano yung nasa gitna para makakuha ka ng 200? 300. Yan yung elimination natin. Ano sabi natin? Dapat at the end, ito ang lalabas natin. Ano yung lalabas? Yung tamang arm's length transaction. What is the arm's length transaction? Acquiree na benta sa third party for 700 and yung actual cost ng 1/2 is 100 times 1/2, 50. So this is our arm's length. So let's see, in case our elimination, we will get our consolidated amounts, which is 750. 500 plus 700 less 500, which is our elimination. How much then is our consolidated sales? 700. Next, 100 plus 250 less our elimination, 300. How much then is our consolidated? Remaining is 50. Gross profit, 400 plus 450 less 200. What is our remaining? We have 650. Did we get the same? Yes, we got the same. Okay? So, in your intercompany inventory, anong technique natin? Kunin mo na yung unrealized profit or yung unsold. I-deduct yan, deduct sa gross profit, remove the intercompany sale, any remainder is the reduction on your cost of goods sold. So pag ni-record natin yan, guys, you debit your sales for 500. So to record it, you debit sales for 500. And then you credit cost of goods sold for 300 and you credit inventory for 200. Because we say the unrealized profit is the overstatement in inventory. So this unrealized profit will decrease our inventory. Clear yan, ah? Sales, i-record mo debit. Tapos, i-credit mo yung cost of goods sold na 300. Tapos, i-record mo uli yung inventory unrealized profit na 200. Let's solve some problems. Ayan. PIA Corporation owns an 80% interest in Euro Corporation. And at December 31, 2018, PIA investment in Euro on a cost basis was equal to 80% of Euro's stockholders' equity. During 2019, Euro sold merchandise to PIA. Sino nagbenta? Si Euro. Binenta niya kay PIA. Okay? Take note, all intercompany sale should be reduced on the point of the seller. On the point of the seller. Who is the seller? Euro. Okay? All adjustments are made to Euro, therefore. Okay? Next, at a gross profit of 40,000, half of this merchandise is included in PIA's inventory. Okay? So 40,000 yung gross profit niya. Gross profit is 40,000. 1/2 is the ending inventory. So what is unsold? 1/2. Okay. So, Euro. Gross profit, 40,000. First step, get the unrealized profit. Unrealized profit, since half dito, so 1/2 multiplied by 40,000, unrealized profit is 20,000. You will adjust that to the seller. Who is the seller? Euro. Okay, so tanggalin natin yan sa gross profit. Next, after we remove the unrealized profit, what is our next step? You remove the intercompany sale. So sabi dito sa problem, Euro sold to PIA 200,000 pesos. So our intercompany sale is 200,000. Okay? And then, the difference is the reduction to cost of goods sold. The difference is the reduction to cost of goods sold. So 200 minus 20, so 200 less 20, our reduction is 180,000. Okay, so what is the adjusted now for euro? What is the adjusted for euro? 600 less 200, 400,000. Okay, so the adjusted now for euro, sales is 400,000. Cost of sales, 400 less 180. We have 220,000. Gross profit, 200 less 20, 180,000. Operating expense of 80,000. Separate income of euro, therefore, is 100,000. Okay. So what is the income from euro? Since our interest in euro is only 80%, controlling interest is 80%, non-controlling interest is 20%. Pag tinanong, income from euro, 80% is 80,000. 20% is 20,000. So our controlling interest is 80, non-controlling interest is 20. Okay. Income from euro, controlling interest yan, 80,000 pesos. Next, consolidated or group cost of sales for 2019. Magkano yung adjusted natin kay euro? 220. Magkano kay PIA? 500. Magkano din ang ating adjusted? 720,000. So the consolidated or group cost of sales is 720,000. Next, the non-controlling interest in net income is, na-compute na natin yan, 20,000 pesos. Okay, so let's look into this problem and let's break it down again. So in this problem, we first determine who is the intercompany seller. So sabi dito, euro sold merchandise. Once you determine the intercompany seller, all adjustments will be to your intercompany seller. All adjustments will be to the intercompany seller. Okay. So how do we compute for your adjustments? First, the unrealized profit. How we determine the unrealized profit? First, get the unrealized profit and determine the unsold. So in this example, our gross profit is 40,000. And how much was unsold? 1/2. So 40,000 times 1/2, then that is our unrealized profit, 20,000. How do we account for it? You deduct it on your gross profit. So ayan, dineduct natin yung una nating na-compute sa gross profit. Second step, you determine the amount of intercompany sale. Who is our seller? Euro. How much is the sale? Euro sold merchandise to PIA to 200,000. So 200,000 ang ating intercompany sale. Next, you determine the difference between the unsold and the intercompany sale. The intercompany sale is 200 and the unsold is 20. So the difference is 180. The difference now is a reduction to cost of goods sold, 180,000. After we get the reduction, we get now the adjusted for euro. So 600 less 200, 400. 400 less 180, 220. 200 less 20, 180. 80,000, do we have adjustment? None. So 80. So 180 less 80, 100,000 pesos. Okay. After we compute your 100,000, dito kasi 80% lang yung kay PIA. Okay. So 80%, that is our controlling interest. What happens to the 20%? It is called non-controlling interest. So to get for the income ni PIA kay euro, that is 80% daw. So 80% of 100,000, 80,000. Ayan. Consolidated group cost of sales. PIA may 500,000. Euro may 220,000. Kaya nakuha ang 720,000. Further, non-controlling interest. Paano tayo mag-compute uli ng non-controlling interest? That is equal to your adjusted net income of euro. Tapos, kinuha natin yung 20%, 20,000. Okay. Sir, saan ba nakukuha ang non-controlling interest? Si PIA kasi, PIA owns 80%. So, ibig sabihin si PIA yung acquirer. Pa-acquiree lagi yung NCI. So, yung acquiree may 100,000. NCI may 20% kaya nakuha yung 20,000. Okay? First example natin as to our intercompany inventory. What is our entry then for our elimination? You debit sales. You remove the sales, 200. You deduct from the cost of goods sold, 180,000 pesos. And you reduce the inventory based on our 20,000 unrealized profit. Okay? Take note, all adjustments will be to the intercompany seller. Next problem. The separate income, which do not include investment income of PIA and Rose, is 80% subsidiary owned. For 2018 were determined as follows. During 2019, PIA sold merchandise. PIA sold merchandise. So question, who is the intercompany seller? PIA. Seller si PIA. Therefore, all adjustments to PIA. Okay. Cost 40,000 for 80,000. At December 31, half of these inventory items remained unsold by Rose. Okay. So if our selling price is equal to 80,000, the cost is 40,000, what is the profit? Our gross profit is 40,000. What is the unsold by Rose? The unsold is 1/2. Therefore, 20,000 is our unrealized profit. So first, determine the unrealized profit. So first, we got this selling price, 80, and the cost, which is 40. Therefore, 40,000 yan. You multiply it to the unsold, so 20,000. Where do we deduct the unrealized profit? In the gross profit. So you remove that on the seller. Sino seller naman ngayon? Si PIA. Next, you remove the intercompany sale. How much is the selling price? Sold to Rose for 80,000 pesos. So intercompany sale, 80,000 pesos. You remove that again with the seller. Next, the difference between the unrealized profit and the intercompany sale is your adjustment to cost of goods sold. So 80,000 less 20,000, what is our adjustment? 60,000. Okay? After that, we're ready to get for the adjusted. Okay. How much is the adjustment to PIA? 800 less 80, 720,000. Adjustment to PIA as to cost of sales, 400 less 60, 340. 400 less 20, adjustment for gross profit, we have here 380,000 pesos. And then we have other expenses of 200,000. So 380 less 200, we have 180,000 pesos. Okay. So the separate incomes of PIA, Rose, it's 80% subsidiary. So PIA is the parent, Rose is the subsidiary. Okay. The first question is, what is the minority interest in net income for 2019? Saan natin uli kukunin yung minority interest? Kay subsidiary or kay acquiree. So who is the acquiree here? Rose. Okay. So get the controlling interest, 80%. Get the non-controlling interest, 20%. 80% times 20,000, 16,000. 20% times 20,000, 4,000. So what is the minority interest in net income for 2019? The NCI, yan ang tamang sagot, 4,000. Consolidated sales, okay, combine the sales. 720 plus 200, 900,000. So how much is our consolidated sales? Our consolidated sales is 900,000. Next, consolidated cost of sales. So cost of sales natin, 340, 120. 340 plus 120, 460,000. 340 plus 120, 460,000. So consolidated cost of sales, 460,000 pesos. And then lastly, the profit attributable to equity holders of parent or the non-controlling interest or the net controlling interest contributable to controlling interest or net consolidated income contributable to your controlling interest. Okay, so for this one, to compute for this, you need to get for the adjusted income of parent plus share in net income of subsidiary. Okay, what is the adjusted income of parent? We already computed that, 180,000 pesos. You add the share in net income of subsidiary, so that is the controlling interest, 16,000. So what is our consolidated net income attributable to parent? 196,000 pesos. Okay. So what are the questions here? You were asked for the minority interest. When we talk about minority interest, that is NCI. Saan nanggagaling yung NCI? Kay acquiree or kay subsidiary? So si Rose ang subsidiary dito. Kinuha natin yung NCI, 4,000. Consolidated sales after adjustment, 720 plus 200, we have 920,000. 920,000. Next, cost of sales adjusted, 340 plus 120, 460,000. Pag profit attributable to equity holders of parent or the net consolidated income contributable to controlling interest, that is the adjusted income of parent, 180, plus share in net income of subsidiary, 16,000, 196,000. Okay, let's wrap up your intercompany sale of inventory. What are the steps? First, determine who is the seller. After determining who is the seller, any adjustment computed will be affected to the seller. The second step, determine the unrealized profit. What is our unrealized profit? That is equal to your gross profit on the sale multiplied by the percentage unsold. Next, determine the intercompany sale. So whatever is the amount of the sales price, that is the intercompany sale. Lastly, compute for the cost of goods sold, which is equal to your intercompany sale less the unrealized profit. Sir, what happens now on our unrealized profit? The unrealized profit this year will be considered a realized profit next year. Okay. So in our example here, our unrealized profit is 20,000, di ba? So next year naman, kung ngayon dineduct mo yan, next year i-add mo naman yan. Add mo 20,000. Why? Because it is considered sold na. So this year i-deduct mo, next year i-add mo. Okay? That is for intercompany sale of inventory. Next, intercompany sale. Intercompany sale of property, plant, and equipment. So in your intercompany sales of property, plant, or equipment, or your fixed assets, there is again an unrealized profit because what do you say? Your acquirer and your acquiree are considered one entity. Therefore, the acquirer or acquiree cannot sell to themselves. They cannot recognize sales on themselves. It must be first sold to your third party. So the problem here in your intercompany property, plant, and equipment, normally it is not sold to your third party. So how do we account for it? Okay. So if we have any unrealized profits or unrealized loss, any unrealized profits or unrealized loss, it will be spread over the life. That is the normal rule. But take note, for your property, plant, and equipment, it is important for you to determine whether the property, plant, and equipment is depreciable or non-depreciable. Okay. Sir, when can I say that the property, plant, and equipment is depreciable and non-depreciable? Because, guys, we only have one non-depreciable. That is your land. Any other PPE is considered depreciable. Okay. For your depreciable, what are the rules? Before sale to third party. Before sale to third party, unrealized gain removed in full, and then annual amortization reduces the depreciation expense. Okay? Before sale to third party, any unrealized gain removed in full, and then annual amortization reduces the depreciation expense. How about unrealized loss? Unrealized loss is also removed in full. Okay? And annual amortization increases the depreciation expense. Again, unrealized gain removed in full, and annual amortization reduces the depreciation expense. Take note of this. Reduces. Loss increases. Okay. How about after sale? After sale. Unrealized gain, total unamortized amount will be removed. While here, after sale, unrealized loss, total unamortized amount will be removed. Okay. Para maintindihan ninyo, let's say, parent sold to your subsidiary, uh, the cost of the asset is 500,000. The book value is 300,000. Binenta niya kay subsidiary for 350,000. This 300,000 has a 10-year life. Okay, 10-year life. So, magkano pinagbenta ni parent kay subsidiary? 350,000 pesos. So, paano yung gagawin natin dyan? Kailangan mong i-remove daw, guys. Okay? You need to remove it. So, to remove it, what we do is, we remove the total gain on sale. So, how much is the gain on sale? 350 less 300,000. 50,000 pesos. So, remove in full. Year 1. Gain on sale. Okay. Next, what do we do? The annual amortization reduces the depreciation expense. Sir, what do we amortize? That is the gain or loss on sale over the life. So how much is our gain on sale? 50,000, di ba? I-divide natin over the life. Ang life niya ay 10 years, so we have 5,000. So year 1, year 2, year 3 hanggang year 10, sabi dyan, annual amortization reduces the depreciation expense. So kung may 10-year life siya, meron kang 5,000 na ibabawas sa depreciation expense. Nasundan? Hanggang year 10. Pagka hindi siya nabenta. Sir, paano kung nabenta siya? After sale to third party. So let's say guys, dito, sa year 4, it is sold to third party. Okay? Year 4, it is sold to third party. At year 4, sabi natin ang rule, the total unamortized amount is removed. Year 1, year 2, year 3, nakapag-amortize tayo. 15,000, tama? So, 50,000 yon, 15,000 lang ang na-amortize mo. Magkano natira? 35,000. After sale, third year, after sale to the third party, the total unamortized amount will be removed. What is that? 35,000. Okay? 35,000. So you will decrease the depreciation expense or recognize additional gain of 35,000. So the amortization here will decrease the depreciation in case of unrealized gain. Unrealized loss increases. So ganun lang guys. You need to get for the unrealized gain or loss. After you get the unrealized gain or loss, pag hindi pa siya nabebenta sa third party, i-amortize mo over the life. So dito, 10-year life. So nag-amortize tayo for 10 years. Pero paano sir, pagka nabenta during the life? Pag nabenta during the life, the total unamortized will be removed. So in our example, year 4 nabenta daw. So year 1, year 2, year 3, nag-recognize tayo, total 15,000. 50 less 15, ang natira ay 35,000. I-recognize mo na as a whole. Anong effect uli? Pag gain, reduces the depreciation. Pag loss, increases the depreciation. Okay. Sir, saan namin i-adjust to? Take note, whoever is the intercompany seller, dun nyo i-adjust. So pag sinabi ang seller ay si parent, doon nyo i-adjust. Sir, paano pag sinabi ang seller ay si subsidiary? E di adjust nyo kay subsidiary. Next, non-depreciable asset, land. So kung depreciable, yan yung rules natin. Okay? Paano naman pagka non-depreciable? Before sale to third party. Unrealized gain, remove in full, including unrealized loss. Okay? Tapos, after sale to third party, unrealized gain and unrealized loss, recognized in full. Okay, so for example, parent sold to subsidiary land for 500,000, cost is 300,000. Parent sold to subsidiary land for 500,000, cost is 300,000 pesos. How much then? 200,000 is the unrealized profit or the unrealized gain. Okay. So, year 1, year 2, year 3, year 4. Sa year 4 lang siya nabenta, for example. Ay, hindi. Wag naman pa na year 4. Year 3 naman siya nabenta. Year 3 siya nabenta. Okay, unrealized gain. Anong sabi natin? Any unrealized gain or unrealized loss before sale to your third party is removed in full. So we have unrealized gain of 200,000, we remove in full. Walang amortization, walang amortization. Tandaan, doon sa depreciable may amortization. Dito, walang amortization. Napansin nyo ba yon? Dito, remove in full, tas may annual amortization. Ayan. Pero dito, remove in full lang. Walang annual amortization. Okay? So on year 3, nabenta siya. Sabi natin, after sale, you recognize in full. So year 3 siya nabenta, you can now recognize in full 200,000. Clear? Okay. Pag depreciable, may amortization habang hindi pa nabebenta. Pag nabenta, yung unamortized will be removed. While in your non-depreciable, if ever it is still unsold, we do not make any amortization. Once it is sold, then we can recognize in full. As you can see the difference. Here, we have amortization. Here, no amortization. 0, 0, 0, 0, and 200,000. Let's try this problem. Income information for 2019 taken from the separate company financial statements of PIA and its 75% owned subsidiary Root is presented as follows. Pia's gain on sale on the building with a book value of 20,000 and 10-year remaining useful life that was sold to Root for 30,000. Okay, so we have here a gain on sale. At what amount will the gain on sale on the building appear on the consolidated group on income? So we said any gain on sale on your property, plant, and equipment should be removed. Any loss on sale should also be removed. So tatanggalin natin yung gain on sale na yan, 10,000. So magkano matitira? Eh di zero. Ayan. So pag tinanong sa inyo, what amount of gain on sale will be presented? Ang sagot nyo, zero lagi. Why? Because gain or loss on sales should be removed. So we remove them, zero. Next, the consolidated group depreciation expense. We said that your gain on sale should decrease your depreciation expense. So gain, decrease depreciation, loss, increase depreciation. Okay. So we have here a gain, 10,000. What did we say? Before sale, it should be amortized over the life. So if our gain is 10,000, what is the life? 10 years. So how much per year? 1 year. Sir, saan nakuha yung 10 years? Yung 10 years dito, 10-year remaining useful life. Okay. So since this is a gain on sale, what is the effect? It will decrease your depreciation expense. So less 1,000. Okay. So after that, how much then is the consolidated or group depreciation expense? 30 plus 80 less 1,000. That is the amortization. How much is our depreciation expense? 79,000. And then the last, the profit attributable to equity holders of parent. So ang gagawin nyo na naman, kukunin nyo muna yung controlling interest dito. So first, get the adjusted PIA income. So our adjusted PIA income, we need to first remove the gain on sale of building, 10,000. So how much then? We remove that 500 less 10. We remove this, add dividend, less cost of goods sold, less depreciation, less other expenses. Our net income is equal to 500 plus 37, 500 less 250 plus less 50. Okay, 138,500. So adjusted parent income, 138,500. Sir, why do you say that the parent is PIA? So sabi kasi dito, PIA Corporation and its 75% subsidiary Root. So si Root yung subsidiary, si PIA ay si parent. So pag tinanong kayo ng non-controlling interest, manggagaling yan kay subsidiary. Okay. Plus share on controlling interest income, we have 75% ownership multiplied by root of income of 50,000. Sir, bakit walang adjustment kay root? Wala naman kasing binenta si root. Ang nagbenta ay si Pia. Okay? Tandaan, lahat ng adjustment, gagawin nyo dun sa nagbenta. Ang nagbenta si Pia, siya yung may adjustment. Okay, so 50,000 times 75%, 37,500. How much then? 138,500 plus 37,500, 176. Okay? So, ang kailangan nyo lang tandaan dito, gain or loss, ito. Before sale, unrealized gain, remove in full. Unrealized loss, remove in full. And then, you will make annual amortization. For gain, it reduces depreciation expense. For loss, it increases with depreciation expense. After sale, any unamortized, if ever it is sold to third party, pag after sale, ibig sabihin, it is sold to third party. So the total unamortized should be removed now, whether gain or loss. But for non-depreciable asset, there is no amortization. Take note of this. Unrealized gain or loss is removed in full. And if it's sold to third party, you recognize in full. Last topic for consolidations is your intercompany accounts. When do we have an intercompany accounts? When the parent or subsidiary has accounts payable or accounts receivable with each other, meaning they are debtors and creditors of each other. So How do we uh, compute for this intercompany accounts? To compute for this intercompany accounts, you will only remove the intercompany account if it is consolidated and there is control. Take note of this. You remove only if you have controlling interest or control, and you prepare a consolidated FS. Take note, intercompany accounts, this happens if ever you are debtors and creditors of each other. Let's have an example. Problem 1, Pink Corporation owns 60% of Sun's outstanding capital stock. On May 1, 2018, Pink advanced 140,000 in cash, which was still outstanding at December 31. So si Pink nagpautang kay Sun. What portion should be eliminated? Question. They prepare conso? Yes, kasi sabi dito, what amount should be eliminated in the preparation of consolidated balance sheet? Yes. Next question. Do we have control? 60%. Do we have control? Yes. So can we eliminate? Yes. Only if there is conso and there is control. So you eliminate 140,000. Ang tanong, what should be eliminated? So you can eliminate 140,000. Problem 2. December, Green Incorporated owned 90% of White, a consolidated subsidiary. So si White, conso, yes. Okay. And 20% of blue. So, control, 20% lang si blue. So, wala yan. Okay. On the same date, green had receivables of 600,000 from white and 400,000 from blue. So, do we control white? Yes, 90%. So, this one should be eliminated. Blue, do we prepare consolidated? No. Do we have control? No. Therefore, the 400,000 is not eliminated. Okay? So, ang kailangan nyo lang tignan sa intercompany accounts, do we have control? Next, do we prepare consolidation? So, sabi natin, kay white, may consolidation, may control, therefore, eliminated. So, the question is, in its December 31 consolidated balance sheet, Green should report accounts receivable from affiliate. In short, yung hindi eliminated. Ang pagtinanong is, what is the receivable to be reported? Yun yung not eliminated. So, sino yung not eliminated natin? 400,000. Okay? So, problem 2, receivable from affiliates, 400,000. Problem 3, Nenita owns 100% of Vilma, a consolidated subsidiary. Vilma, 100%. So, control. Tapos sabi, consolidated subsidiary. So, okay din yan. White, an unconsolidated subsidiary, 80% may control, pero unconso daw siya. Unconso, so bawal yan. Tapos, si Nenita may receivable na 400,000 kay Vilma. At kay Willie naman, meron siyang 350,000. Ang tanong, what should be the amount reported? Okay, so si Vilma, conso, check, control, check. Therefore, this will be eliminated. Kay Willie, control, check, consolidated, not check kasi unconsolidated siya. So this one is not eliminated. Ang kailangan nyo lang tignan, ano ang tanong? Ang tanong ay, how much is the AR to be reported from investee? Kung AR reported, sabi natin, pag AR ang tinanong, yung not eliminated. So, anong sagot natin? 350,000 for problem 3. Problem 4, Choco Company from affiliated companies. So, 150,000 cash in candy. So, sa candy, you have 30% ownership. So, no control. So, not eliminated to. How much? 150,000. Next, Receivable of 520 from Cake. Cake is 100% owned, so there is control. And included in consolidated financial statements. So there is conso. So this is eliminated. How much? 520,000. And a receivable of 500,000 from wheat for merchandise sales on credit. 90% owned. Therefore, there is control. However, unconsolidated. So, not eliminated naman to. So, dalawa yung not eliminated natin sa problem 4, si Candy at saka si Wheat. Ang tanong, what should be reported as accounts receivable? So, yung not eliminated yan. 150 plus 400. 550,000 pesos. Okay, problem 4, 550,000 pesos. So, in your intercompany accounts, just look whether they are consolidated and there is a presence of control. If both are present, eliminated. If not, if one is not present, then not eliminated. Okay? Pag not eliminated, that is part of AR. If eliminated, it will not be presented. So that's all for our intercompany transactions, intercompany inventory, intercompany PPE, and intercompany account.